from the moment you purchase that house and even before you move in, housing represents opportunity, right? So housing is never just a place to live. Oftentimes I speak with people who have certain misconceptions or certain things they've told themselves or have been convinced through other people that makes them think that, they're not able to move forward or they're not able to take advantage of their situation. Some common misconceptions people have is just that, either I haven't been in my home for long enough for me to be able to take advantage of anything, or my home hasn't increased in value enough for things to be valuable for me and for me to be able to take advantage of this. If you own a property, there's several things you can do.
Today I am talking to Shawn Zupan, and he's a real estate agent in Nova Scotia. And today we will be talking about the equity in your house. Welcome to the show, Shawn. How are you?
Good. Thank you so much for having me. Great place you have here. I'm really happy to be here. Very excited to be on the podcast and chatting with you today.
Thank you so much. Listen, when I talked to you for the first time, I got a different impression. You have a different perspective, and I like to go deeper in that perspective. When is the moment that a house becomes more than a place to live? Can you help us with that?
That's a great question. Honestly, I think that a house is never just a place to live. I think from the moment you purchase that house and even before you move in, housing represents opportunity, right? So housing is never just a place to live. It always represents more than that for several reasons.
And tell me, do you have any story that you can share with us about how a house can help you to grow your wealth in Canada?
So over the years, I've worked with several clients, both buying and selling, and I've had the opportunity to learn some really great stories and help some clients work through some really interesting opportunities using their equity in their home to help push them to kind of the next step financially. I have an example of a couple I worked with back in 2019. They purchased a home in Halifax. To put it simply, their mortgage payment at that first home was about $1,800 per month. We explored other options for kind of what they were looking for. They stayed in that house for about 3 years and were ready to kind of explore their options with their increased equity. Ultimately, they were looking to have a multi-unit and start making income from tenant-occupied properties, whether that's owner-occupied or fully tenant-occupied properties. And this is an interesting story because what we did here is we say, how can a larger mortgage payment actually save you money? And this is kind of what we did in this circumstance. Like I say, their original mortgage payment was $1,800. They ended up selling their first house and purchasing another house with a higher purchase price that had a income unit in the basement. So what they did was they sold their first house, bought a second house that was more expensive. Their new mortgage was actually $800 more expensive than their first mortgage at about $2,400 per month. But because they have that rental unit, they're able to charge about $1,600 per month for that rental unit. So by purchasing a more expensive property and actually having a larger mortgage, their mortgage payment has been reduced by $800 per month. And now after their tenant pays their rent at the end of the month, they're actually only responsible for $800 to pay themselves now versus $1,800 before when they were living kind of in their single family home. So I think that's a really good example of kind of how you can take equity in a home that you already own and use that to purchase a property and actually lower your expenses, lower utility costs, maybe do some other improvements in your own home. It's a great example of how you can actually take equity in your own home and use it to improve your financial position.
I was talking to a friend the last week, and he told me, if you understand the market and how equity works, you can even live for free in Halifax or anyway.
Absolutely.
Because you can build some wealth buying properties. Meanwhile, you are increasing your income.
Absolutely.
And do you have another example about that specific strategy?
So yes, I have another example of a client that I work with that used equity in a different way. So this is a gentleman that was from outside of Canada, born outside of Canada, and moved to Canada several years ago. When he moved to Canada, he realized that the credit system we have in Canada is quite different from what he has in his home country. It's a very cash-based system where he's from, no real credit system. So, if you're doing something like purchasing a house there or building a house, for example, you would save money, save up enough money until you can pour your foundation, right? And then you'd save up some more money until you can frame the walls, save up some more money and then finish it off. So there is no credit system where you can take advantage of assets or investments and actually leverage that money. So when he moved to Canada, he realized there's this great opportunity where you can leverage assets and you can borrow against any assets that you have. So what this gentleman did, he was able to save up some money and he was able to purchase a tenant-occupied rental property for a certain value. And what he does, instead of, because of course there's several ways that you can increase the value of your property. What I would say is natural appreciation, right? Which happens over time. When you look at the big picture of the real estate market, obviously things go up and down. But when you zoom out and look at the big picture, the real estate market overall increases over time. So of course, time in market is kind of the biggest thing about gaining value through natural appreciation. As the market naturally increases in value, so does your asset. But there's another way to increase the value of your property in what I call forced appreciation. So forced appreciation is when you can actually take steps to improve your property through several means. So this gentleman who purchased these rental properties, he forced the appreciation through a few different things that he did. The first thing he did was actually do improvements to the property. So smart upgrades and maintenance, right? The biggest things you always want to focus on first with properties are your major systems, right? So things like the roof, windows, foundation, electrical, plumbing. These things are major things that you want to make sure are functioning properly in the house to ensure that it stays in good condition for years to come, right? Secondary things to think about are the cosmetic stuff, right? Stuff like the flooring and then the paint colors and, the countertops and stuff like that. Those things are all important. But if we don't have those major systems in good condition and good working order, then the paint color and the cabinets don't really matter as much. So the first thing we do to force appreciation is we make sure that our systems and our home is well maintained and in good structural condition. So that's always the first thing that we do to try to force appreciation is actually increase or improve the systems of the house. The next thing that he was able to do, now this is unique to tenant-occupied properties, is another way that we can force appreciation is to actually increase the value of those rental contracts, right? So we can do that either by increasing our rent, right? Or we can do that by reducing our utility costs. So for example, if we can change windows to make them more efficient, or we can update heating systems from an oil system to an electric-based system, that reduces our utility costs, which then increases our profit at the end of the day. Of course, for tenant-occupied properties and in the investment space, your cash flow is kind of the most important thing when we talk about the value of the property. Because from an investment point of view, it's how much money am I spending per month versus how much money am I bringing in. Obviously, the more money you bring in versus your expenses, the higher the value is. So this gentleman, what he does is he purchases tenant-occupied properties. He forces appreciation through improvements and to both the condition of the property and the rental atmosphere. And then what he does is he takes his increased value, gets these properties reappraised by the bank, refinances these properties at a higher value, and takes his increased equity to go purchase his next rental property. So this gentleman, I believe he's been here since about 2018 or 2017. He now owns 2 rental properties in New Brunswick. He owns a rental property in northern Nova Scotia, and he also owns a property in Halifax. So now he has 4 or 5 properties that he owns, several rental units, 5, 6, or 7 rental units in total. And he's done this simply by leveraging his assets, forcing the appreciation, and then kind of moving forward that way. And his plan right now is it seems like he's not planning to slow this down anytime soon. So
that's my goal.
Yep.
I want to do exactly the same. And I need to understand the different conditions, because if you are living here in Halifax, you may not access to another house out of the city because
Yep.
you are not living there. You are not that is not your permanent place to live. So you need to analyze that structure and your goals, especially your goals, right? How can you help those people to reach those goals?
Absolutely. And, I would say in Halifax, we say that there's what's called the primary rental market and there's what's called a secondary rental market. Primary rental market would be in Halifax, in the Halifax Dartmouth area, where we have high rents, we have very high rental demand, and we have high property values, right? So in most cases, when investors are purchasing in Halifax, in most cases, the strategy is a more long-term kind of hold the property with the intention of the profit and the payoff coming off later when the property's value increases over time. So in most cases right now in Halifax, when investors are purchasing tenant-occupied properties in Halifax, they're usually not cash flowing immediately because where that investment payoff comes from is the long term. That's what we'd call the primary market in Nova Scotia. We do also have what's called a secondary rental market in Nova Scotia. That's what we would call the cities outside of Halifax. So New Glasgow, Truro, Amherst, Antigonish, for example. These are areas that they still have, fairly large population centers, so fairly high rental demand. The reality is because of the supply of rental, the rents in these cities are still fairly high, comparable to Halifax in some areas. But the big difference is in these secondary markets is the property values are much lower. So what that means is because you have comparable rents to Halifax, but much lower property values, it becomes much easier to cash flow on those properties immediately. And it's a shorter term return on investment.
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
So, for anybody who's thinking about getting into the rental market and they want to get started with something like a strategy of forcing appreciation, I would say looking at the secondary rental markets is probably a good place to start. For example, this gentleman that I mentioned, that forces appreciation through several rental units. One of the properties he purchased was up in Amherst. He purchased a 3-unit property for under $200,000, and now he's through several ways of forced appreciation. He's increased the value of that property quite a bit already.
I don't have words for that because when you are starting, especially in my situation that I am starting in a new life in a new country, you are starting from scratch and your affordability is low. So you cannot afford a house here in Halifax and you think that you cannot access to the market. But just thinking about that example that you can buy a multi-unit property in Amherst, for example, and you can increase your assets and you can create wealth almost immediately with the low capacity of debt that
Absolutely.
you have, right? And what happened with people who is thinking about to enter to the market, but they don't have, or they think that they cannot access to the market right now, for example, when we have like this uncertainty in the market.
I mean, uncertainty is a big piece of this, right? We can certainly, as realtors, we have access to data. That's a huge piece of our value as realtors, is we have access to current data for listings that are happening right now in Halifax, Nova Scotia, but also past listing information, right? So we can kind of extrapolate information from data. But the reality is, we're not future fortune tellers, right? So, we can use data to predict what may happen based on what's happened before. But right now, where we have so much uncertainty, things are uncertain, right? That's the only way to put it. And that makes people a little bit more stressed out. Absolutely. What that means for someone who may be thinking about getting into the market, I would say the biggest thing is knowledge. Knowledge and information is power. Oftentimes I speak with people who have certain misconceptions or certain things they've told themselves or have been convinced through other people that makes them think that they're not able to move forward or they're not able to take advantage of their situation. I think some common misconceptions people have is just that either I haven't been in my home for long enough for me to be able to take advantage of anything, or my home hasn't increased in value enough for things to be valuable for me and for me to be able to take advantage of this.
That's exactly my situation. On my mind, I think that if I buy a house today, I cannot do anything in 5 years in order to recover my investment. But what you are saying now, I am learning something new today. Thank you so much. Is the first appreciation because I can make improvements and I can do it.
Absolutely. Absolutely. So I would say, if you own a property, there's several things you can do, right? Like I mentioned, natural appreciation is the first and easiest thing, right? Because time will do wonders for people owning property, right? As you've seen, so much wealth that we see in real estate simply comes from time and from people owning their asset for a long time. We see so many people right now in Nova Scotia. Most homeowners in Nova Scotia have owned their property for more than 5 years, right? The vast majority of Nova Scotia homeowners. As we know, property values in Nova Scotia over the past 5 years have changed dramatically. So any of these homeowners, or most of these homeowners that have owned their properties for more than 5 years, there's been this major increase in equity that people have had, and this leads to a huge amount of opportunity for people, right? So obviously, like I say, time is one factor through natural appreciation, but there is other ways to take advantage of your value through what we would call forced appreciation, like I say. So through forced appreciation, there are several ways to do this. The first thing is going to be those smart upgrades and maintenance, right? Making sure that you're taking care of the major systems and structure of your home to make sure it's going to last a long time. Of course, things like adding bedrooms or adding bathrooms, doing additions to your existing house. If you can expand the square footage or the footprint, or add more usability for future homeowners, that's a great way to add value to your current home. I would also say a great way to force appreciation is to increase the efficiency of your house. So making things, updating older systems to make things more efficient. Things like insulation is massive. Things like windows makes a huge difference. Because again, if you can reduce your utility costs and at the same time increase the value of your property, that's kind of a win-win financially. One thing that I've learned kind of in the last couple of years in this industry, if someone is planning to sell their home, the reality is the seller will pay for updates either way. Okay. So whether you are planning to sell your house and you say, I'm going to sell it in as is condition, and the person who purchases my house, they can update it how they want to, which is okay. There's nothing wrong with that. Or whether you want to decide to sell your house and you say, I'm going to update every last feature and fixture of this house to make sure it's up to modern standard. The reality is that when you're selling your house, you're going to pay for those updates either way. Because if you're leaving that to the buyer to do those updates, you'll have to reduce your price. Realistically, that's just the reality. If you're doing those updates yourself before you sell, then you can expect to sell your house for a little bit more money. So the reality is you as the seller will pay for those updates either way. It's just about making sure you're doing smart updates, efficient updates, and the right updates.
And I have a question here.
Yes.
Nowadays, people are struggling with money. Mm-hmm. We don't have a lot of employment. The wage is low. And I may think I have my property, I have to sell it, or I want to sell it, but I don't have money to do the improvements. Do I have any opportunity to do that?
That's a great question as well. I would say, oftentimes people think that if I want to pull money out of my house, I need to sell it. And that's my only option. But that's not true. There's a few different options available. I would say that the biggest misconception comes from lack of education, right? And lack of knowledge. So that's why I say knowledge is power. Taking an opportunity to really learn about your situation and what makes sense for your needs really goes a long way. And that's why I kind of focus on a knowledge first business.
Okay, just imagine I bought my house 20 years ago and I paid off my debt. I don't have any mortgage on it. and I want to sell it, but I know that the condition right now is not the best. So I like to make some upgrades, but I don't have the money. How can I improve the value of my house in order to sell it?
That's a great question. One common misconception people have is that the only way I can get the value out of my house is to sell it. A great option that people have is what's called a refinance. So you can speak with your mortgage broker, your bank, your mortgage specialist to discuss a refinance with your mortgage broker. In this case, what we do is you're able to pull the value out of your house based on its new appraised value. So of course, if you purchased your house 10, 15, 20 years ago, it's safe to say that the value back then was probably quite a bit lower than it is now. And you would have gotten your mortgage based on that value at the time. If you've now been paying your mortgage for 10, 15, 20 years, and it's been reduced quite a bit or completely eliminated, now you have so much equity built up in the value of that house. So what you can do is you can go to your bank and you can pull the value of that money, that new increased value that you have in your house. The bank will lend that to you as a refinance, as a new mortgage on your house. There's several ways that they'll do this. There's something called a home equity line of credit, which in that case, they give you kind of 80% of the value of your house as a line of credit. You can keep that line of credit untouched and you don't get charged any interest on that line of credit until you use it. So let's say that you wanted to do some improvements before you sell. You could have your home equity line of credit at 80% of the value of your home. And you can use that money to do some improvements. Say you wanted to update the heating system, add a new bedroom, fix the flooring because it's in poor condition. You can use that money. Let's say you take $100,000 from your home equity line of credit to do these improvements. You'll only get charged interest on that portion that you use from your home equity, that $100,000. And then, of course, when you go to sell your house, you would pay off that remaining balance. And then anything else you would have would be, of course, your proceeds from the sale. Ultimately, this is more on the mortgage side of things than the real estate side of things. So I would recommend certainly speaking with a mortgage broker or mortgage specialist for more information on home equity line of credit or refinancing options.
Thank you so much. That is something important because I can see this information that you gave me like an opportunity, because a lot of people who is struggling now with the current economic situation, they may have opportunities not only to use their property without selling it. Probably they can increase their properties, for example, in Amherst or in another place, and get a new income, but they are not exploring the opportunities that they got or that they built with their properties. Is that correct?
Absolutely. And I mean, I think real estate, there's risk in real estate. Like with any investment, there's risk in real estate. And what it boils down to is risk tolerance, I think. Sometimes people will say, people who purchased a house right before the pandemic, people often say, oh, you're very lucky, you're very lucky. I think luck has something to do with it, but nobody could have predicted what was going to happen with the pandemic. So people that purchased properties before 2020, the reality is they took a risk when they made that investment and the risk paid off, right? Sometimes the risk doesn't pay off as hugely as it did during the pandemic, of course, for some people. But the reality is, I think what it boils down to is kind of how much risk you're willing to take and how much risk you're willing to put up on the other end, I suppose.
And I will argue your argument, because I would say that everything is a risk. Even doing nothing is a risk. So for me, the biggest risk is not taking action.
That's a good point. That's a really, really good point. You're right. Because I guess everything is a risk, and potentially it's a bigger risk to do nothing at all.
Exactly. So probably we can take a risk and build some equity in the way.
Absolutely. Absolutely.
Okay.
Yeah.
And what is the best place that people can reach out to you to find more information, to build a strategy?
Well, as you know, I come from an education first standpoint for my business. I think knowledge and education is hugely important anywhere, but especially when you're doing something as major as a real estate purchase or selling your home. So I do provide a huge amount of short form educational content on my social media page. Please feel free to check it out if you'd like to know more.
Thank you so much. I appreciate your help, and probably you can come and answer some specific questions that we have in this topic about the equity.
Absolutely.
And how people can grow their wealth through real estate.
Absolutely. I'm happy to be here anytime.
Thank you so much.
Thank you.